begin by telling you a story that happened to me back when I was in Seattle. I had sold my company and I was taking my two kids to middle school every day and then going across the street to the coffee shop to have a cup of coffee with friends. And this is a story that happened from that. I've told it before, but I think it's apropos to right now. Today is July 25th, 2023. Welcome to my YouTube broadcast. My name is Ben Reppond. The year was 2009, and I was taking my two youngest children to middle school, went across the street to Tully's. If you're from Seattle, you know that Tully's is or was a big name coffee shop in the area, and it was across the street from the school. This is actually a picture of the counter. And I walked in and there was a line to give your order. At the end of the line, in front of me, was a guy I recognized. He was a friend of mine. His name is Bill. And from behind, I said, "Good morning, Bill." And he recognized my voice. And he turned around and he said, with a big smile, "Good morning, Ben. How are you?" And I said, "Fine. How are you doing?" And he said, "I'm doing great." Well, this was September of 2009. The economy was kind of in shambles. And those who were in the banking industry and in the real estate or construction trades, everything had come to a stop. And there was not much business being done. Most contractors went out of business. Bill was a contractor. So I said, "Bill, it's curious to me that I'm glad you're doing great, but it's curious to me, I know you're a contractor and I know what's going on. Tell me how you're doing great. I'd love to hear the story." Because I could tell he was very sincere about what he said. And he said, "Get your coffee and come over here and I'll tell you the story." So we sit down and I said, he said, "Actually, back in 1999, so this is 2009, so this would be about 10 years before the time that we were talking." And he said, "I was building houses. One day, a guy walks in my office, one of the young men that was slinging sheetrock, and he hands me his resignation, and he said, I want to give you my resignation. I'm going to resign, quit." Bill said, "Well, what are you going to do?" He said, "Well, I found an easier way to make a buck." Bill said, "Well, tell me about it. Maybe I'd be interested." He said, "Well, it's very easy. You just borrow $50,000 and you buy Microsoft stock." And Bill thought a minute and he said, "Are you sure?" And the young man said, "I'm sure." So Bill took his resignation. The young man walks out of his office and Bill closes the door. He gets on the phone with his stockbroker and said, "Sell everything I've got." He said, "Bill, I'm getting phone calls every day, all day long from people who want to buy more stock. The market is going up like crazy. Tell me why you want to sell." He said, "Well, it's very simple. They just reeled in the last sucker." Bill said, "Okay, fast forward to 2007, 8 years later." He said, "I'm sitting in my office. As fate would have it, in walks another young man wanting to resign." And he said, "Why do you want to quit?" He said, "Well, I found an easier way to make a buck." He said, "I'm going to get in your business. You build a home, there's always somebody to buy it, and you make a pretty easy $150,000. That seems like a lot better way to make a living." Bill looks at him and he says, "Are you sure?" The young man said, "Yes, I'm sure." Walks out, Bill closes the door, gets on the phone and calls his wife and says, "Honey, I've decided to sell the business." "Why are you doing that, Bill?" "Well, they just reeled in the last sucker." You see, there is a correlation between that and today, I think. Now, we are not today at the top of the market. We have been, but the market has pulled back some. But still, the valuations of companies that are part of the stock market are still elevated. And we have seen a period of time, of course, we saw 2022 where the market, bond, and stocks generally went down. We've seen a period of time in 2023 where stocks, not bonds, but stocks have gone up, have had a very nice run, And there has been a feeling that I've picked up during the past 6 months at certain times where people are starting to pile on. And they call this feeling the fear of missing out. People want to get on board because the market's going up. I'm going to play you some clips, a couple of clips. There are some positives in the market. There are some reasons to believe it's going higher. I agree. But there are storm clouds out there that are significant, and I will share that information with you as well. There is, and particularly if you look back in this past 6 months, and not just look at the S&P 500 or the broad market, but if you look kind of like 1999, you look at Tesla and Netflix and NVIDIA, companies like that, they've been on fire. So there is a tendency to want to get on board and get these huge returns from these kinds of stocks. But when I look at that, it reminds me a lot of my friend Bill. And if you want to do that, you're welcome to do that. I don't do it that way, but be my guest. But I would say be cautious, be careful, because right now the market has become so elevated and so overextended, so overbought, that the downside risk, in my opinion, is much higher than the upside opportunity. Now, in full disclosure, we are fully invested. We have been fully invested most of this year. We did get out of the market in February and part of March. And other than that, we've been in most of the time. So I do believe the market is going higher in the short run, but we manage it tactically. We manage it with a methodology. But if you're doing your own, or unless you have extreme confidence in what you're doing, be careful. I want to play a piece from Mohammed El-Erian. He's being interviewed by Becky Quick at CNBC. And I want to put this, she's asking 4 distinct questions about his thoughts on certain things. And he's very well thought. I think a lot of them, and his views are very usually spot on and to the point. So I'll begin by playing the first one, which is his optimistic view of the market. And I think there is a reason to be optimistic. And he gives some rationale behind that. So let's listen to this piece first.
Our next guest says that markets are being propelled by the relief over what has not happened, despite some residual uncertainty out there. For more on that and the soft landing narrative, we want to bring in Mohammed El-Erian, who is Chief Economic Advisor at Allianz and President of Queen's College at Cambridge University. Mohammed, no news is good news, basically?
Well, we've had news, and it's been good news in the sense that it has fueled this soft landing narrative. And this soft landing narrative has coincided with money on the sideline. So the two things together lead to something that you want to be part of. You don't want to be pushing against. That is the tactical view for the next few weeks. Beyond that, we're going to go back to the issue of how sticky is inflation. Will the Fed overdo it? And can the economy and the non-bank financial institutions navigate the cumulative impact of the rate hikes? But I would not get in the way of this rally, and it's being fueled not only by domestic factors, but as we see today, by international factors as well.
From what he said, Becky Quick is pushing back and referencing a Bank of America report which says that most investors are still bearish. And that would tell me they're either inverse the market or they're in defensive stocks, or probably most of them just sitting on the sidelines. And that was a result of 2022, and they never got in. The market took off, and they were kind of sitting on the sidelines, and that's where they still are. And I think she says there are 60% of investors are bearish right now. And so she asked him this question, and here's his response.
Bank of America has their July Global Fund Manager Survey out this morning, and I was a little surprised to see that according to them, that sentiment still is pretty bearish out there. They said 60% of investors expect weaker global growth, higher levels of commodities, and that the fear factor is still greater than greed. I mean, that's usually a recipe, if you get good earnings numbers, to bring some of those people back into the market.
Yes, absolutely. That's why the technicals are favorable, is because you've got people who have stayed out of this market and now are being pulled in by a very strong soft landing narrative. You know, soft landing narratives are wonderful because you can get higher stock and bond prices. So they bring people in across the board and out of short-term cash, because what's also happening on short-term cash is that yields are coming down sharply. So you have both the push and the pull factor. And I don't expect this to change anytime soon. When we get towards the end of the summer, when we get to Jackson Hole, it will get a lot more interesting.
Another good question that Becky Quick asked is, okay, granted we're in a rally right now, what could derail this rally? That's a great question. What is there that's out there that maybe some people don't see? And so he gives 3 potential scenarios of what could derail the rally. Take a listen.
Mohammed, what could be a catalyst? I mean, people still waiting for something to happen potentially in the fall. How likely do you think that is? If a soft landing is much more likely, what's taken out here? Is the Fed potentially getting to the point where they're going to stop hiking rates, and maybe that leads to a little calm among investors and the markets?
That's the hope. The market clearly thinks that we're going to get one more rate hike next week, and that's it. And the next move will be a cut. The Fed is not there yet, so we will be listening very carefully to what Chair Powell says about the forward guidance. What could get in the way? A few things. One is a Fed that over-tightens. That could get in the way. 2 is inflation proves to be sticky. There's a number flying totally below the radar screen, which is what happened to core inflation in the Eurozone. That went up rather than come down. So the inflation dynamics are worth keeping an eye on. And then don't underestimate the cumulative effects of the rate hikes, especially on the highly levered sectors. So these things are to watch. That's why you want to be tactically risk on, but strategically keep an open mind and keep on revisiting these 3 factors.
Okay, so Mohammed El-Erian's got this optimistic view. And when the market has reason, there's reason to be cautious or negative, he's willing to go there. He doesn't just adhere to one narrative. He looks very carefully and says what he thinks. So she asked him another great question. She says, what would cause him to change his mind? Good question. He gives 2 scenarios. Take a listen.
What would make you change your mind? What would make you say, okay, forget it, risk off?
Oh, it would make me change my mind if the Fed comes out, for example, and says, I don't care about what's happening. I am going to still do at least 2 more hikes. And the word at least would be, the market will not like that at all. That's one possibility. The other possibility is some sort of small accident among the non-bank financial institutions. We know commercial real estate is under pressure. Today, we're getting earnings from the regional banks, and the good news are deposits are coming back. The bad news for them is their funding costs are going up significantly.
Now, I play Mike Wilson quite a bit. Mike Wilson from Morgan Stanley, and he has his thoughts on the market, which he gives every week or nearly every week, and he's been bearish on the market since last December, and they got it right in their call in October, got out in December, and the words he uses are we took our chips off the table. In other words, they made some money, they got out because he saw that earnings potentially were going down. He could see that clearly they were going down, and he's been holding to that view for the last 6 months. And so he gives a defense of that. And then, excuse me, he says his view of the market going forward and what's going to cause the market to come down sometime during the rest of this year. And it's always been earnings. He says earnings are coming down. Now, before I play this, I just read a piece by Stanley Druckenmiller, that hedge fund manager, who said the same thing. He said he believes that corporate earnings are going to decline 20 to 30% from here to the end of this year. Well, if something like Mike Wilson's scenario or Stanley Druckenmiller's scenario is correct, that is not good for equities. And it is probably not good for bonds as well.
Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, July 17th at 11 a.m. in New York. So let's get after it. Last week was all about the downward surprise to the June inflation data. More specifically, both the consumer and producer price indices came in well below expectations and suggest the Fed is on its way to winning its hard-fought battle to beat inflation back down to 2%. Both stocks and bonds celebrated the news as the likelihood for a soft landing in the economy increased. Our view is not so sanguine on stocks, as the steeper fall in inflation supports our view for a much weaker than expected earnings growth. 3 years ago, at the trough of the pandemic recession, we were a lonely voice on the idea that inflation would surge higher due to excessive fiscal and monetary support. Furthermore, we suggested it would lead to a surge in earnings growth as companies discovered an ability to raise prices at will while the government subsidized labor costs. As we moved into 2021, this over-earning broadened out as consumers spent their excess savings on everything from sporting goods to travel and leisure activities. By last summer, this boom in spending was so strong, the Fed was forced to raise interest rates at a pace not seen in 40 years. With the lag in monetary policy close to 12 months, it should be no surprise that we are now seeing the headwinds on growth and inflation today. Because markets are forward-looking, they understand this dynamic perhaps better than the average investor. In fact, it is the primary reason we decided to get tactically bullish on U.S. stocks last October. At that time, we suggested long-term interest rates and the U.S. dollar would top in anticipation of the Fed's aggressive policy having its desired effect on inflation and growth. That began to play out in the fourth quarter as price-earnings multiples expanded from 15.3 times in October to 18 times in early December. We decided to take the money and run at that point, thinking the market had already fully discounted the peak in inflation, interest rates, and the U.S. dollar. Over the next 6 months, 18 times did provide a ceiling on valuations. However, over the last 6 weeks, valuations have risen another 10% as the inflation data confirm what we already knew. Meanwhile, artificial intelligence has given investors something to get excited about, but at unattractive valuations in our view. As noted earlier, we think inflation is now likely to surprise on the downside. A move to disinflation is positive for stocks because valuations typically rise under those circumstances. However, that has already happened. Now we expect disinflation to shift to deflation in many parts of the economy. In other words, prices begin to fall. Most are not forecasting such a decline because it seems hard to fathom after what they've witnessed in the real economy. However, it's just the mirror image of what happened in 2020 and 21 when supply was short of demand. At that time, inflation surprised companies and investors to the upside and led to much better earnings growth than forecasted. Now pricing power is fading due to demand falling short of supply, and this is likely to surprise many companies and investors to the downside. More importantly, it's not expected by the consensus anymore, or is it in stock valuations at this point? We are already seeing pricing come down in many areas like consumer goods and commodities. Housing and cars are also seeing price degradation, especially in electric vehicles where supply is now overwhelming demand. The bottom line, while falling inflation last week was great news for the Fed and its war on higher prices, equity investors should be careful what they wish for, as this is a slippery slope for earnings growth and hence stock valuations, which are now quite extended.
I thought I would update you on debt. Now, what's in my opinion, the thing that's probably going to hold the market back and the economy back from this point forward is debt. Now, debt, in 1980, we had $1 trillion in government debt. So from George Washington through Jimmy Carter, we accumulated $1 trillion in debt. Since that time, from 1980 to 2008, we accumulated 9 trillion more, a total of 10 trillion. So from 2008 until today, we have gone from 10 trillion to 32 trillion. I think the last time I played this, it was 31 trillion, and the time before it was 30. I mean, it just jumped right through 31 trillion so fast. And so it is moving up very fast. The problem now, the double-edged sword here, is that we're not meeting our budget, so we're spending money we don't have, we're borrowing money, and the interest rates have doubled approximately. So if interest rates have doubled and the rate is going up faster and faster, and this is not just us, this is every country, developed and underdeveloped country are facing the same problem. So I thought I'd give you some stats. I just kind of put the figures on here. This comes from the website usdebtclock.org. So you can go there. On the front page is literally exactly 100 sets of numbers. I'm pulling 7 out of 100. So there's a lot of data there. I just didn't want to show all of that because most of it's not relevant. But the U.S. national debt today is 32.6 trillion. That's kind of the number. Now let's look at the annual number. Annually, the government's taking in 4.7 trillion on the left top. That's the green box. Below that, we are spending 6.2 trillion with a deficit of 1.5 trillion. When you take in 4.7 trillion, I know a lot is entitlements, but I don't know why they can't figure out how to keep it at 4.7 or less, but they somehow can't do it. What's interesting, that the interest on the debt has gone from around 300 billion to 645 billion. The biggest culprit is the rate of interest. So that of that 6.2 trillion, 600 billion of that, or about 10% of that, is due to debt. When you go beyond just the U.S. government and you go into state governments, county, city, corporate, personal, the total debt in America, all of the borrowing, is 101 trillion. When you go over into derivatives, it goes up to about 200 trillion. So, and the interest on the total interest is 3.7 trillion. So these are big numbers. I mean, I can't even fathom a trillion. So these are horrible. But what is going to slow the economy down, and not just the U.S. but other countries, in my opinion, is the anchor that it's got around our neck that's holding us down and keeping us from growing, because we accumulated a lot of this debt during a period of low interest rates. And if interest rates go on higher, they're going down right now. They went up and now they're coming back down. I think for the next few years, I think we're going to be looking at higher interest rates. If that happens, it's going to make this even worse. As I thought about this, I thought about that throughout history, I'm going back to the Roman Empire forward, I thought of all of the countries or empires that have collapsed. Every one of them has collapsed for usually several reasons. Sometimes it's political, sometimes it's war, and sometimes it's economic. And in every case that I could find, every one of them took on too much debt. So the debt may be the primary reason, or it may be one of several reasons. But the debt becomes the, again, I think it's the anchor that pulls these down. And you can see Roman Empire, Byzantine Empire, Spanish Empire, China twice, 1912 and 1947 with Chiang Kai-shek. And then Germany, 1918, actually Germany's had several collapses. Russia, 1918, Ottoman Empire, 1922, it went on for a few centuries. And then Imperial Japan was defeated in World War II. And then the Soviet Union collapsed in 1991. So there's many, many more, and I went through and looked at, ones in South America and really throughout the world. And the story behind each one of them was always debt. And so as I look at this, this is not new. Where is the United States on here? We have been going for quite a while, but these empires have gone for a few hundred years, and then they were dominant, and then the debt eventually crushed them, or it made it very difficult so that they actually had to make bad choices. Thought I'd share this. One of my my favorite philosophers is the great Will Rogers. Do the best you can and don't take life too serious. Thank you for watching. If you have questions or comments, leave them in the comment section below.